Recent data out of the US is painting a picture about the state of the economy. That and the uncertainty around the path of interest rates is helping to fuel volatility in the bond market. So what are the implications for grade corporate bonds? Rachana Bhat is Vice President, Active Fixed Income Portfolio at TD Asset Management. She joins us today. Rachana, thanks very much for joining us.
Thank you. Thanks for having me.
All right, so let's just jump into it. I know that your focus is investment-grade corporate bonds, so maybe start off with a bit of an explainer.
Yeah, sure. And aren't we all ready to just check out at this point in the year? It's got so much going on. But anyway, so let me start by explaining what investment-grade corporate bonds are. So these are bonds that are issued by relatively high-quality companies. So we're talking about companies like Apple, Amazon, Bell, and TELUS. So the risk that you don't get paid your principal or interest on time is extremely low for these bonds. But because these are corporate bonds, they pay you a higher yield than government bonds. And that extra premium is because you're investing in a company rather than a government entity.
And you're taking that additional risk that's paid to debt holders.
Correct. And that extra premium is called the spread in bond terms. The higher the risk you take with a company, the higher the spread and higher the yield you earn. But it's always important to ensure that you understand those underlying risks and the compensation, whether it's aligned to those risks or not. And that's where we spend most of our time as corporate credit managers.
Okay, so let's talk a little bit about the credit spreads right now. Where are they in terms of, are they tight? Are they wide? What's your outlook on that?
They're tight. So spreads were actually tight coming into 2024, and they've just tightened further. And remember, just keep in mind that when I say spreads are tightening or falling, it's actually positive for corporate bonds. It's a good thing. And when you look at US investment-grade corporate bonds at this time, they offer about 5.5% in yield in US dollar terms, and Canadian investment-grade corporate bond offers about 4.5% in yield in Canadian dollar terms. But when you strip out that government rates component from it and think about just the risk premium that we just spoke about, or the spread, that's quite tight. And think about this. Credit is a mean reverting asset class, which means over time, the spreads tend to gravitate towards their long-term average. So if let's say I applied a 20 basis points in widening to US investment-grade corporate bonds, guess what? They would still be about 30 basis points tighter, so materially tighter to their long-term averages. That's how tight the market is. When you shift to Canadian investment-grade corporate bonds and you apply that same logic of 20 basis points in widening, we're slightly better, we'll get to the long-term average. And that's why, because Canadian corporate market is better priced, we are skewing more towards, Canadian corporate bonds, but we're also mindful that our economy is more rate sensitive, so there's some extra compensation that this market deserves.
Okay, so what are the risks right now? Because having a tight credit market or narrow credit market is a bit of a double-edged sword. What are the risks for those credit spreads to actually widen out further?
Yeah, when you think about, there are quite a bit of risks, and maybe we have to first understand what have caused spreads to be tight. I think that's the first question to ask. So let me answer that question. That why are spreads so tight? So spreads are tight not because of that Trump euphoria trade, which is what everybody's been thinking. But in the bond land, it's actually driven by higher yields. When was the last time that you actually saw, greater than 5% yields being offered for a high-quality asset class? Not in the last 15 to 20 years. In fact, just 3 years ago, it was, 2.5%. So what that's doing is the demand for this asset class, because yields are attractive, it's a fairly safe asset class. And third, the fundamentals are quite decent on the economic and corporate side, that this demand is on fire. And it's not just coming from one kind of investor, but it's coming from a variety of investors, which is overseas, which is foreign investors. It's coming from retail investors, from insurance, from pension. So it's a lot of, it's more spread out in terms of demand. So if you can bring up, I did bring a chart here to show you some of this dynamic that I'm talking about.
So what is this chart showing us here?
Yeah, so if you look at this chart, if you look at the gray line here, it's showing you US investment grade corporate bond yield, and the green line is showing you US investment grade corporate bond spread. Look at the last part of this chart. The higher the yield actually went, the gray line, the tighter the spreads got towards the end. And that's because of what I just spoke. There is more buying happening because there's an urgency to lock in these yields, because the expectations are that yields in the future are not getting any more higher from where it is. But look at the graph again and look at point in 2023, so October 2023, and you see that spike in yields, but you see a spike in spreads as well, the green line. So they were more positively correlated then. So you have to think about, why did that happen? That happened because the expectation back then was that we could see more rate hikes and that yields could go even higher. And nobody wants to catch a falling knife, because when yields go up, prices fall. And you don't want to be in losses, which is why demand stepped back. So that's an important consideration to keep in mind, that demand will be strong at these yields, conditional on the fact that yields, the expectation on future yields is not a lot higher from here. And that's the dynamic we've seen, where there's a lot of buying going on, less selling, which is driving spreads to be tighter. And we call this analyzing technicals in the bond land, which is analyzing supply and demand. And that's one of the two key pillars for how we think about the spread outlook. So that's on the tight side. And I think that I had to answer that first before I got into the risks.